Greetings, good morning. Welcome back. So, today, as you could see by the title, we're going to start talking about investing for beginners. It's overall how uh, to plan for growing your wealth over time. Uh, it is, once you understand even the basics of investing, it is a powerful tool um, to allow you to grow your money over time, whether it is simply for retirement or even a targeted investment for um, a specific purchase you want to make later on down the road, like a home. All right, so what is investing? So, at its core, investing is putting your money to work so that it can grow over time. Putting your money in a savings account is not investing. The idea is to buy assets that have the potential to increase in value over time. Obviously, the common ones are stocks, bonds, real estate, mutual funds, even a business. With, as we said, the goal is ultimately to build wealth and with businesses and real estate to generate income for the future. And some stocks obviously have a dividend that they pay over time. Not massive, but it accumulates as you grow. Maybe you're asking yourself, why should you invest? So, if you are relying on just your savings account, your money is losing value over time. Um, Somewhere, I'm trying to think what the exact numbers are, but approximately if you were a 1970s dollar, for example, by today's standards would be about 2 or 3 cents purchasing power, equivalent purchasing power. So if you had just kept that money in your savings account, even if you had, a 2%, 3% over time, inflation has eaten away your purchasing power. So you want to try to find a way to grow your money faster than inflation can eat it away. So it's a long-term game. It's not something just to uh, put it in one month and hope for uh, wealth beyond imagination the next month. Um, as I said, it's you could set it for like most people, your retirement. You can have shorter term investment goals like uh, paying for education, even buying a home, but figuring out what you want to invest in and the reason you're wanting to invest. Overall, investment works on the property of what's called compound interest, which over time builds on itself. Once you earn, say, just as a easy example here, say you earn 5% every year. Well, at the end of that year, you have 5% more in your account. Well, the next year, you're earning 5% more on your original investment plus that additional 5%. So over time, it does grow. Now, as I said, you're wanting to try to overcome the power of inflation. Uh, as I'm sure if you've paid attention over the last 10 years, uh, for various reasons, inflation has just massively eaten away at your purchasing power. Things have become more expensive, which is not exactly accurate, but directionally, yes. From a perspective, what you are purchasing is getting more expensive, but it's because the purchasing power of your dollar is going down. So the earlier you start with your investments, compound interest will work better for you and be more beneficial. And as I briefly mentioned, passive income. If you have rental income, interest that you earn on high yield accounts, or dividends for stocks that you may own. And if you're just a quick side note, so for dividends, what that's doing is it's taking a certain very small percent of, say you own 100 shares of a stock. Well, over the course of a year, they're going to pay you 6%, for example. Most of them are not that much, but say 6% in dividends, which means they're taking that money and giving it back to you. So at the end of a year, you have 6% more money in your account. Now, what you can do to kind of help you along is that's paid to you slowly throughout the year. What you can do is you can take that dividend that they give you and have it auto buy the stock. So every time they give you a dividend, you just auto reinvest it back into buying more of that stock, so that over time you're going to own more of that stock, and therefore your dividend's going to be higher during each period and at the end of the year. So next in the category, obviously, is risk versus return. Every investment that you're going to put your money into, or potentially put your money into, there's a risk. Real estate has a high risk. It'd be what's called a credit risk, because your borrowers may default. They may abandon the property and you're left having to pay everything. So when you put the investment in, especially in real estate, assume you're going to be paying for everything for the rest of your time owning it. Don't just assume you get renters in there and now you're free and clear and it's easy money. It's not that simple. So understand that the higher the potential return, the higher the risk. The lower potential return, lower the risk. Investing in stocks and ETFs. What's affected that is what's called your market risk, so the fluctuations of the market. And if you've been paying attention, there's been billions of dollars lost in the last couple of months in the markets, just because of that volatility that's there during certain economic and political times of crisis. So understand your risk. For short-term investments, you probably want to be paying more attention to that. But if you're looking at 30, 40, 50 years out, historically, it hasn't mattered. There's been very few times that if you invested for the long term that you didn't get it back within a reasonable amount of time. And obviously one of those was the Great Depression. It took, I think, 10, 15 years to come back to the value that the original market had. But again, even on a long enough horizon, even that came back. So if you had been investing in that 15 year period was extremely rough, but 20, 30, 40, 50 years later, you were in a better position. And as we talked about previously, inflation risk. If you're just leaving your money in a savings account, you're losing purchasing power. If the investments you have do not at least keep up with inflation, preferably they beat inflation, you're going to lose money. You're going to lose purchasing power. So do your research, understand your risk versus return versus how well it's going to beat inflation over time. Understand what inflation is. Do your research, understand what the different inflation gauges and metrics are, so you understand if you are beating inflation and what you could do to help that. All right, different types of investments. As we talked about, stocks. So what a stock is, it is ownership in a company. You own part of that company. If you own one share, now most of the large caps, they've got hundreds of millions, if not billions of shares of stock out there. So if you own one share, it's not a lot, but it is something. You are part owner in that company. And if you've ever received them in the mail or not, you get to vote on the direction of the company, different policies, procedures, whether or not the board of directors, if they have a re-election, if there's somebody that is trying to run for office, you get to vote on who sits in the board, who your different managing directors are. If there are certain policies or the companies want to implement, you get to vote on that. Now, obviously, with one share, it's not that powerful of a single voice, but it is a voice. The more shares you have, the larger your voice. Kind of makes sense. Overall, as we've seen over the past 100 years or more, stocks do tend to have a higher potential return over time. But as we saw with the Great Depression, as we are seeing with the market fluctuation now, there are times when it is highly volatile and you could lose a lot. Just be aware of that risk. On a short-term horizon, it could be difficult. On a long-term, it does not tend to be a major catastrophe. Next would be bonds. Bonds are simply like a loan to the government or possibly a corporation. Lower returns, but safer, generally speaking. Mutual funds is just kind of like pooled investments managed by professionals. ETFs, or what are called exchange traded funds, it's sort of like a mutual fund, but they're traded like stocks. ETFs are usually like a basket of stocks, so that whatever the ETF is set up. So like, you ever heard of SPY or QQQ? Those are ETFs that are specific. So your SPY is the 500 largest companies, and companies get on and fall off of that all the time. QQQ is more your technology sector, based on various factors, whether or not they get in that fund. Real estate, as we talked about, is another investment. I would not say it's volatile, but it is a higher risk because you have to make sure you have renters in the properties, that you're keeping up with your investments, or you're keeping up with the maintenance of the rental properties, and whether it's a multi-tenant or a single-family home. It's still, as the owner, it is still your responsibility to make sure everything is taken care of, however that may be. There's also something called REITs, real estate investment trusts, that kind of track an overall market value of different types of real estate, commercial real estate, retail, single-family home type stuff. And finally, it would be like your index funds, a type of mutual fund to track the stock market, like the S&P 500. It's a overall tracking the market type things. So as we talked about, setting your goals. setting your milestones for why are you investing? Are you just investing to keep your purchasing power? It's not a bad goal, not a bad idea. But maybe, as most people, for retirement. That's the main reason for investing. And the better your investments, obviously, the sooner you can retire. Maybe you have a shorter term goal like education, different plans you can do for that, for investing. A home, if you're trying to purchase a home, getting investments toward that. You're going to have to ask yourself, what is your risk tolerance? How risky are you willing to be? Obviously, if you're young, you can tolerate a lot of risk. I would still recommend talking to a financial professional to help you understand what risk you should be tolerating and what risk you shouldn't be. As we talked about before, with the 50-30-20 portfolio, you're only going to want like 20% of that into any kind of investment stuff. I recommend trying to go to 25, even 30% investments, but approximately 20% in investments, and then of that 20%, a very small portion into really high risk. So you want your high risk, and then another portion into medium risk, and then low risk. And that fluctuates over time. So the younger you are, this high risk portion may be larger, and this low risk portion may be smaller. But as you get older, you and closer to retirement, you want that lower risk. So determining when you will need your money will determine what your investment strategy is. So how do you start? Open a brokerage account. Plenty of online places if you want to do a self-managed investment. Obviously, you want to do lots of research for yourself before you do that. You can go down to find many other professionally managed accounts. Just tell them what you want overall, and they'll set up some sort of an investment for you and meet with you usually about once a year. You can meet more often, but usually once a year is more than enough to adjust over time. If you're doing it yourself, even with a professional, they're probably going to start with index funds or ETFs. It just offers better diversification and lower costs for your investments. If you're doing it yourself, look at the different sectors that are available out there. There's a lot of different sectors, from utilities, real estate, energy, technology, communications, materials, healthcare. There's a lot of different sectors out there. That way you diversify across those sectors. That way, usually if one sector is going down, another sector is going up, or they may be moving just a little bit with each other. But do your research on that if you're going to be doing it yourself. Set it up automatically for your investing. So figure up your budget, as we talked about in previous lessons. Set up your budget, that 20% of your total income, 50-30-20. Remember, 50 was for your absolute needs, 30% is for your wants, and 20% for your savings and investing. If you decrease your wants, which I highly recommend, and increase your investing, it'll work for you better over time. But most of the places I could saw 50-30-20. But set up that investment automatically. Just go in, set auto draft, if not directly from your paycheck, directly from your bank, $100 a week, $100 a month, whatever. Just set that up automatically and just set back. Check it once a quarter, once a year, whatever you feel comfortable doing. Just be as hands-off as you can. Over time, it does tend to work out better for you than personally managing unless you are just in the investment world. And finally, just be patient. Investing is a marathon mindset. It's not a sprint. You're not going to put $100 or $1,000 in and going to be a millionaire by the end of the year. That's not going to happen. Yes, you hear stories about that happening, but it's not going to be you. Just just make that assumption because you're going to be right. 9 million times out of 10 million. 9,999,999 times out of 10 million, you're going to be right. You're not that person. The people that do that usually are already in the investing world and know all about that. So, common mistakes. Trying to time the market. The common phrase is time in the market versus timing the market. There are better times to invest more of your money, absolutely. But just time in the market. Different ways of saying it. ABB, always being buying, or DCA, dollar cost average. Just over time, say for example, putting $100 a month or $100 a week into something will yield you the best return over time. If you're in the market, obviously, and you understand the cycles and the true value of different stocks and ETFs, yes, there are better times to invest more money, but it's the from everything I can tell, the marginal rate of return, it's not much better. Maybe 5-10% over the course of a lifetime. Don't invest without researching. Don't just pick the next recommended stock that you see some Reddit or website shout out to you. Do your own research. Figure out what it is, what it's doing, what that company is all about, what their real value is. Don't invest on emotions. That one is much more difficult for most people, especially when you see so many other people out there making thousands, hundreds of thousands, millions of dollars on an investment. You're like, yeah, I need to throw it in. I need to get, no, don't stay away from emotional investing. Find a method. If you're self-managing, find a method and follow that method. Adjust that method based on statistics, based on evidence, based on experience, not on emotion. Also, don't put all your money into one investment. Yes, true. If you put all your money in one investment and it goes through the roof, you will make a lot better money over time. But diversification should be your destination. Also, be wary of fees. So certain investments have a lot of fees that can eat into your profits. Certain stocks, ETFs, the way they're managed. Also with real estate. Don't forget everything that comes with real estate, home ownership, your property taxes, repairs, all that can eat into your profits over time, into your value over time. So just take all those into consideration. Do the research on stocks and ETFs. So finally, there's a lot of tools and resources out there. You got different platforms, Robinhood, Vanguard, Fidelity, Schwab. There's what are called robo-advisors, different, probably thousands, tens of thousands of resources like Investopedia, Morningstar. Just educate yourself regularly. Read books, tutorials, follow experts on different platforms, and kind of get your own idea of what type of investing works for you, because the same thing doesn't work for everybody. Uh, in closing, understand that investing isn't just for the rich. Investing is how the rich became rich and stay rich. It's not just for financial experts. People right now are learning, especially with since the advent of the internet, and it's growing. There's just so many resources out there. So if you're willing to put the time and energy into the research, you'll come out better in the long run. It's about your future. How do you want your future to be? I'm sure you work hard. I'm sure you work 40, 50, 60 hours a week. And you need to expect and want your money to work just as hard as you, if not harder. You may work 50, 40, 50, 60 hours a week, but guess what? Your money can work all 168 hours of that week if you do everything right. And over time, and that's the key, over time, your money working hard, growing, can set you up better for a more comfortable retirement and being able to afford like a home, a vacation, whatever targeted goals or milestones you have. That's I think pretty much everything that I wanted to go over here. If you have any questions or comments, I know this is still, as I talked about originally in the previous videos, this is just kind of very high view of what to look for, what to look at. I mean, if you have questions, comments, you want me to try to delve into, create another video on a specific topic, I can do that. Just make comments below. Let me know what you might be looking at further, anything you want. And I will see you in the next video. Thank you. Have a wonderful day.